So, age-old question: pension versus ISAs. What wins and why?
They're not the same product, so you can't really compare them directly. So they have very different pros and cons for them. So they're both tax efficient in different ways, but also how you can access them and when you can access them is also really important.
Yeah.
So let's start with ISAs, so individual savings accounts. So basically you can access them whenever you want. So you can put your money in, but you could get it out the next day if you wanted to. You're not locked in at any point unless you do a fixed rate ISA, which usually locks you in for a year or two. Those are cash products. Yeah. But if you do an investment ISA, you could turn around in a week's time and take your money all back out again and you haven't lost anything, unless the investments have done badly. Cool. But there's no tax on ISAs. So there's no tax on money in, no tax on the growth and no tax on withdrawals. But you can only pay in £20,000 a year. So for most people, that might be sufficient and they might not even be able to put in the £20,000 a year. So it's a really good place to start because you can have cash ISAs, which are just cash products you can get from the bank, or you can have investment ISAs, which are invested in the stock market. Okay. There are other types of ISAs like lifetime ISAs, help to buy ISAs, innovative finance ISAs. They're all a little bit more technical and they all have different pros and cons. But as a basic strategy for investing, ISAs are a fantastic place to start for that reason.
Yes. So easy to access. Mm-hmm. Easy to put your money in, no restrictions on taking it out, no. And there's some pretty good tax benefits in there too. So that's what I'm hearing from that. So, okay, let's move on to pensions. So how are pensions different? And maybe give a little bit of a, pros and cons of kind of pensions, I guess. Yeah,
sure. So the big thing with pensions is you cannot take your money out until you hit retirement age.
Okay.
So at the moment, it's age 55 that you can access your personal pension. Mm-hmm. That is going up to 57 under current legislation by 2028. Okay. And then they're planning to always have the age you can access your private pensions be 10 years before your state pension age. So as state pension age goes up, yes, the age you can access your private pension is probably going to be 10 years below it. So that will naturally creep up. So you've got to be happy that you're putting that money in a pension and you can't get it back out for the long term.
Sure.
There are rules about being terminally ill, and if you're in really ill health, you might be able to get it out early, but broadly speaking, it's a long-term investment. But then it has better tax benefits and larger allowances. So you can pay more in more quickly and it's got a long time to work harder for you.
Sure.
So pensions have tax benefits in that there's no tax on any money in. The government actually tops up your contributions. And then when you come to take money out at the other end, you can take a quarter of your pension pot tax-free. And the rest, you can either go off and buy a secure income for life, or you can leave it invested and take out money as and when you want it. But once you've had your tax-free amount, it will be taxable as if it's an income. So you will pay income tax rates on it. Now that is all based on current legislation, so it might change.
So it sounds to me, obviously, they're both very different rules, different kind of tax benefits. Although you can't give advice in this particular kind of environment, would you suggest that typically a balanced kind of portfolio, including ISAs and pensions, if someone is looking at tax efficiency, that's a good way to kind of go?
Yeah, absolutely. I mean, I like for a lot of my clients to have both of them alongside each other because you might not want to wait until age 58 to get your pension. You might want to retire a few years early. And if you've got a nicer portfolio there, you can use that to bridge the gap until you can access your pension. Okay. And if you need to get it early for some reason, if you need to take your money out because something happens, you've got your ISA portfolio to dip into, even though you can't touch your pension for another decade or whatever. Okay. So it is helpful, I think, to have them both run alongside each other. Cool. You can do that on different platforms. You can have two products side by side. They can invest in the same funds or different funds. But ultimately, it's just having that flexibility then to take income as you want to, rather than being stuck and having to wait until you hit a certain age to access your money.
It'd be quite an awful position to be in if you had, like, I don't know, 400 grand and a pension, for example. You just needed 20 grand for something and you can't get hold of it. And
absolutely.
It's like, it's there. You know what I mean? I guess it's almost like being the kid that's walking past the toy shop at Christmas and they point at the toy they really, really want and you just can't have it because it's behind that glass cabinet. Yeah. It's way too expensive. Mm-hmm. It's like, so that's pensions and ISAs. Mm-hmm. Really appreciate that. Is there anything else that you wanted to add that I haven't kind of asked you about around those two different types of investments?
I think with ISAs as well. I mean, with pensions, you need to invest a pension because it's invested for usually such a long time. If you're going to hold a cash in a pension, it's not going to work very hard for you over the longer time. With ISAs, you can have cash ISAs, but you make sure you're getting a good rate if you've got a cash ISA because there can be rates that are 0.something% or even 1%, whereas at the moment you can get 3 to 4% on a cash ISA if you go and look for a better rate. Okay. That might not be in your high street bank. It might be somewhere a little quirkier, but just check it's got the protection of the FSCS, the Financial Services Compensation Scheme, and then it will be backed. And then if it does go kaput, you will have the protection there.
One thing that I wanted to follow up and actually ask from what you just said there is that I guess, inflation is meant to run at around about 2%, but you've obviously seen it a lot higher. But let's just say historically 2%. Mm-hmm. If you're only getting 1.5% of your cash ISA, can you let our audiences know exactly what that actually means to the value of their investments?
Yeah, it basically means you're losing money on your ISA, because even though you might think 1.5% it's not that bad, if it's being eroded by inflation at 2%, you're losing 0.5% a year if it is a static figure, for example. So really, your ISA needs to be at least 2.5% or higher. It needs to be above the rate of inflation if you want your cash ISA to grow.
Yes.
And that's how stocks and shares ISAs can be more beneficial, because although there is an element of risk with investing, the likelihood is it will always outperform cash, especially over the longer term. So if you're looking for better returns and you've got the appetite to take some risk, then an investment ISA might be better.